It's a new intro for Ask the Experts. How fabulous is this?
I am so happy. No more Hollywood squares.
I am happier. That is fantastic. I'm Jill Schlesinger, and this is
Jack Otter.
And we're from CBS MoneyWatch, and that is our new opening. Ask the Experts.
A blizzard of money.
I love it. Just watch it, and the money will blow through your life.
Exactly.
Fantastic. Today we're going to be talking about housing and mortgages, and we've got a great guest who I will now introduce. Keith Gumbinger. By the way, I want to call him Gumby. I already embarrassed myself, but you know, what can I do? It rolls off the tongue. He's vice president at HSH.com, the nation's largest publisher of mortgage and consumer loan information. He's the primary researcher and writer for HSH.com.
Tongue Twister Associates.
Woo! Market Trends newsletter. I'm the weekly mortgage rate radar. He's authored and co-authored all a bunch of things. He's all over the place. He knows mortgage, consumer debt, housing, you know it all, right?
Well, most of all, yes, absolutely.
That's excellent. So we're going to take a bunch of your mortgage questions, and if you've got some more questions, you can send us an email, asktheexperts@moneywatch.com. You can log into moneywatch.com and join the chat. We've got a whole slew of questions, but first let's do a quick recap, Jack, on what happened today in the markets. So, you know, we started the day off, and I was really thinking NASDAQ 3000. I was kind of getting psyched for it. I did all my information. I looked up when it first, crossed, in 1999, first crossed 3,000. Last time we were at 3,000 back in December of 2000.
Wow.
So that was on the way down.
Yeah.
Right. But then again, we started higher, and then the Dow was up. Ended up being down 53 points. So we've settled down at 12,951, under 13,000.
The market always kind of freaks out when it crosses those psychological thresholds. So after you cross 13,000, it's a pretty good bet. You're going to have a little dive in the next couple days.
NASI down almost 20 points at 2966. S&P 500 down 6.5 points at 1365. So that's sort of the scorecard for the day. Interesting, Apple. The share price of Apple, just so we're clear, $542.44. You know, Jack, that makes Apple worth more than $500 billion in market cap, and there's only 19 countries that have GDPs that are more than $500 billion.
Yeah.
Will it keep going?
That is the, $600 billion question.
Exactly.
As we always say, there is absolutely no way to go. I think there's a lot of, I would say probably the general feeling is that it will keep on going, which is always scary. Jim Stewart had a good column in Saturday's Times suggesting that the law of big numbers will eventually drag it down. You know, the one thing that I keep thinking could actually just power Apple even much farther is the corporate business, because right now I think Apple has about 4% market share of computers. So what if it were to actually break into the corporate world? CBS Interactive is now going Mac. GE is giving its employees the option. Everybody's got iPhones in their pockets, iPads.
And now iPhones are replacing BlackBerries for a lot of companies.
Well, exactly.
Right?
So it's not impossible that what is it, iOS, or is iOS the mobile system, or is that the desktop system as well? But whatever, the Macintosh operating system could start to break into the corporate world, and if so, there's a huge untapped market there.
This is not a suggestion you should go out and buy Apple stock.
Absolutely
We're just
not.
like talking.
Yeah.
You know, come on, don't worry about it. We also found out today that the economy grew at 3% in the fourth quarter of last year, and that is an upward revision. We originally thought it was 2.8%. All the guys that I talked to in the last few days said it's going to get revised down to 2.7, 2.5. Comes out at 3%. Nice upside surprise.
Well, there seems to be, the momentum seems to be in the economy right now towards surprises on the upside. And I'm proud to say that I sat in this room not so long ago and said that's what I expected. The damper, I like to be Debbie Downer, and I haven't been able to be Debbie Downer for a few weeks, is that I think this was, and it's not me talking, I mean, apparently it was inventories being built up. And so that is a short-term kick that doesn't extend, because once inventories are built up, shelves are filled, then that goes away.
And they don't do that again in the first quarter once they do it. And there was a lot of buying.
So we may slow down.
And a lot of buying in the fourth quarter to get some tax preference on corporate spending. So that
because we should explain, because there was a tax break, right, that ended at the end of 2011, where you can't now expense big purchases quite so quickly. So that may have contributed as well.
And then we have Mr. Bernanke in the news again. So he gave his semi-annual Humphrey Hawkins testimony before the House Financial Services Committee, and he basically said what we already know. He said economy's growing, not that fast. We're going to kind of be at the same rate as we were at the end of last year, so that puts us at 2.5%. He said that interest rates are going to stay low until probably through 2014, but he also did say, don't freak out about these gas prices because this is temporary. You buy it?
Well, there's so many factors that go into it. I mean, we have no idea what's going to happen in Iran and with kind of the ratcheting up of the volume of that conflict, and that can send gas prices skyrocketing. If economic growth continues, that puts upward pressure on gas prices. But of course, a lot of it has to do with market expectations. So traders day to day are the ones that push gas in one direction or the other. And right now, I don't see any reason to sell your position. So until that happens, I think gas prices stay high, creep up toward the summer. If we have a slowdown, if tensions relax with Iran, if China, we have an interesting story on MoneyWatch right now that points out that the Chinese housing bubble seems to be bursting, or at least letting air out real fast. Property prices in China are coming down quickly. So there's one potential trigger. China could slow down, and then I think you'd really see gas prices come down. But otherwise, I don't see much of a catalyst.
Okay, so let's move into our topic du jour, which is housing. And we got some mixed data in the last couple of days. We did a video about this yesterday, that pending home sales were up. We saw house prices down again from the Case-Shiller report. And this morning, the Mortgage Bankers Association said 30-year fixed-rate mortgage, 4.07%. So how are we supposed to feel about housing right now?
Well, you and I have been saying recently that for long-term purchasers, it's certainly a great time to be a buyer, not a great time to be a seller. In fact, we were saying that maybe what's going on right now is people are finally throwing in the towel, recognizing their houses ain't worth what they used to be, and doing some selling. But clearly, it looks like we're bouncing along the bottom. And of course, these numbers completely hide the market-to-market local things. In fact, Keith and I were talking about a guy named Jersey Gilbert, who I think was the person who taught me that housing is really a local phenomenon. And certainly we see that on the coasts. I mean, in New York, what housing bubble? I mean, everything's, or maybe the housing bubble still exists. Prices are still going up. San Francisco, obviously, prices have been going up. Vegas, I was amazed to see it kept on falling. I didn't think housing prices in Vegas could go down any farther.
Unbelievable. It's down about 60% from the peak now. It's crazy. So, Keith, let me ask you, we've had low mortgage rates for so long, and in that Mortgage Bankers Association report this morning, we saw that refi activity kind of calmed down a little bit. It was actually down a little bit in the last week, but new purchase activity is up.
Well, that's the important portion of the marketplace right now, is that purchase money mortgages are starting to pick up, and people are actually hoping that we're going to have a real spring home buying season for the first time in a number of years.
Are you feeling optimistic?
Probably more optimistic than most.
Okay.
We've been watching signs over the last couple of months that says home sales are firming up a little bit. I mean, it's not a boom by any means, but firming up a little bit. Unfortunately, it does seem with the home prices that the things which are selling are the low-priced homes. So your home prices are going in one direction, but sales have been getting a little bit stronger. So a little more optimistic than most, but of course, local markets really dictate what's going on. I mean, even a single property in a market might be very well supported in terms of price. The other side of town, not so much.
All right, well, we got a question from Larry in Dallas who wants to know whether he should refinance. He's 64 years old. He plans to work for another 5 years. He's got a 4.25% loan for $358,000. I have 27 years left on my original loan. I have enough in my 401k to pay off the loan, but would rather use that as additional income during retirement. I'm also thinking of refinancing for 15 years instead of 30. What do you tell Larry from Dallas?
Well, normally with a 4.25%, I would say it's not worth the fees associated with refinancing. But given his age, if he can swing that 15-year mortgage, that's not a bad idea. Keith would know what his rate is going to be right now, probably under 4%, right?
About 3.5% right now for the size of the loan he's looking at. But there's also other ways to consider playing that opportunity. Now, he's going to retire in just a few years. Might consider looking at something if he's planning on moving, and that's always an uncertainty, but he could look at something that's not fixed for 15 or 30 years, but only for 5 or maybe 7 years. Now, some of those hybrid ARM products, and I know ARM's still got a bad connotation in the world, but fixed for 5 years or 7 years, you can find interest rates in the 2.5%
Right.
range.
If he's saying I'm going to leave my house in 5 or 7 years, I'm going to downsize, I'm going to move into a condo or something, that could make it affordable,
If
right?
your plan is clear and you really are very good about and diligent and responsible to your own financial plans and say, I'm going to be here 5 years, there's no reason to buy 15 or 30 years worth of fixed rate mortgage. You can buy less and save a lot of money.
All right, Jack and Beth own a duplex in Easton, Massachusetts.
Don't tell my wife.
Why?
Sorry. No, my name's Jack.
Oh, okay, got it. Oh, yeah, that other Beth of yours, yeah. Okay, in Easton, Massachusetts, they're crying about Jason Varitek, and sorry about the Patriots, not really. They're trying to refinance. Their son lives on one side of the duplex. Do you know of any banks that will let us refinance without living in the home?
Non-owner occupied stuff has been very difficult over the last couple of years. Banks really got burned by properties that were sort of quasi-owner occupied, but not really. So they're very wary about making loans to non-owner occupied properties, unprofessional landlords. The process, it's not impossible, but it's going to be more difficult. They're going to need to go find somebody who's interested in working with them. It's going to be few and far between, so it means knocking on a lot of doors, making a lot of phone calls, talking to them, being prepared to produce their financials over and over and over again, cash flow for the property, all the things that will go into it. Not impossible, but it's going to be challenging.
So do you think it's more likely if they go to a local bank or a credit union, or is it just go out there and shop it around?
Some of the best opportunities today come from your local market participants, and that is a local credit union, small bank, or a small thrift. Not every bank or thrift is in the same fiscal position. They can't all just jump up and want to run out and make you a loan. But you'd be surprised how many are very interested in making loans to good creditworthy borrowers right now. The complaints from the industry are there's not that many qualified borrowers.
So in essence, really this is like a shadow of the boom, that basically the banks got burned and they just don't want to do this anymore. And chances are we'll get back towards that. Maybe, we've gone from one extreme to the other, but do you envision a time where the non-owner occupied rules will loosen up a little bit?
Slowly but surely.
Okay.
It's going to be some time, but over the next period of time, 2 years, couple of years, things will begin to loosen up as we go along.
Okay, here we go. Steve in Virginia has 3 questions for us. Ready? Jack, you're going to like this. If my credit score goes up while my mortgage application is with an underwriter, should I request a new credit report to be run?
Why not?
Why not?
Can't hurt, yeah.
I would think so. Number 2, why is there such a huge difference between the credit score I see when I run my report and the one used by the mortgage companies?
Depends on which ones the mortgage companies are using. Now, you may pull a single credit report from a single entity, which has a single value. Mortgage companies and lenders will generally pull what's typically called an in-file report, where they'll pull it from all 3 repositories, and then some will have their own software to run their own score against you. So it's not simply a FICO thing. It's not necessarily a beacon score thing. Some will do their own scoring models to produce their own number, which makes them comfortable so that they can lend you money.
Okay, and here's the 3rd question from Steve. What happens to the balance owed to the bank if you sell your house and had negative equity? Is it still payable over a 30-year period? I think what he means is it basically did a short sale.
Right.
So if you have a short sale, hopefully it's released.
Depends on the terms you negotiated in your short sale. Hopefully it is released.
But in other words, if you can actually negotiate and say, I'll keep paying this?
You couldn't. Well, I don't think you're going to find they're going to be interested in over a 30-year period.
Right.
But if there was a short in your sales price to what you owe, you can probably figure out a term plan in order to get that repaid.
I didn't even realize that, because I thought if it wasn't secured by anything, they wouldn't do it anyway. But they're out the money anyway, so why not?
They'd be interested in getting whatever they can get back. So.
Okay.
And a reminder, if they don't, there's a possibility you'll get hit with a tax bill.
Right.
Correct.
Not this year, because I think this year it's waived still, right?
For 2012?
Isn't it? Well, no, 11.
11,
Tax
yeah,
year.
2011.
But
Yeah.
not 2012. Yeah.
Okay, Lois says her mortgage is currently higher than the home is valued. Wah, wah. Not late on any payments. I don't want to miss any payments. What options do I have for refinancing with a fair credit score? I think 0 options if you're underwater, right?
Well, actually, the new HARP program, which is gently rolling its way into the marketplace, we're still waiting for Fannie and Freddie to update their software so that lenders can push people through the systems more quickly, may be an option for her. Now, she'll have to first determine whether her loan is owned or backed by Fannie or Freddie. They have lookup tools at their websites to do that.
Right.
And if it is, then she's going to want to get in touch with her servicer and ask, what sort of HARP program is available to me. I mean, depending upon how deeply underwater she is, there may be an immediate opportunity, or there may be one that's coming yet. So,
All right, here's one from Monica, who lives in Falls Church, Virginia, and she's now somewhere between $60,000 and $80,000 upside down. 2 loans, an interest-only ARM for $220,000 that's at 6.25%. And an ARM, this must be a home equity, or a second, For $40,000, that is down at 3.375. So 220 at 6 1/4, 40 at 3.375. Thanks to new HARP regulations, I now qualify for a refi. I began the process with my current bank, SunTrust, but I am not sure if I should go through with it. They want to lock me into a 30-year fixed rate at 4 1/4. The driving force for this refi was to lower my payment, but it looks like I'll only save about $63 a month. All closing costs except about $500 will be rolled into the refi. Do it or don't do it.
Gosh, I guess the question is there a better deal available? I mean, certainly in any other universe, 4 1/4, 30 years was a great deal.
Sure, pretty competitive.
And 5 or 10 years from now, that'll probably sound, wow, I can't believe I had that opportunity. So I guess I'm going there. But she's 60 to 80,000 underwater.
Upside down, yep.
Yeah, I mean, she's locking herself into a situation where, unless something strange happens in the real estate market, she's going to be paying into a black hole for quite a few years.
That's the unfortunate nature of all this, is even if you can refinance and save yourself a few dollars, you're going to be underwater for a very long period of time.
Yeah.
You could still be looking at a short sale circumstance down the road at some point. But if you have an opportunity for virtually no money to save $63 a month.
That's what I would say. What's the downside?
You're probably not going to do better in terms of interest rate.
Yep.
You're really not changing your cash flow position all that much, but some.
Yeah, and if the market does go up and you want to stay in the house, I mean, that's the other thing. If you really want to stay in the house, it's not a terrible thing to have this locked down and say, I'm going to be here for a while, and let's ride it out.
Sure, it's a consideration of time. I mean, the longer you're going to be there, the more likely you are to get back to a positive equity circumstance at some point. Even if you don't, you're looking at a short sale circumstance now. You would if you refinance too, so why not save the $60 a month?
And also with the ARM, things could get ugly if interest rates change. So,
Right.
so you're at least locking in some confidence in what your future cash flow looks like.
Can we just go through the HARP rules again? So the HARP rules allow you to refi, but you have to be current on your mortgage, and you can be upside down, right?
You can be upside down, and you have to be current on your mortgage.
And it has to be owned by
has to be owned by Fannie or
Freddie.
Freddie, right. Presently, if you're up to about 125% underwater, the original HARP program is in place. So you can talk to your servicer, talk to your lender, see if they can't move you into that refinance. Now, the new program, which has basically no cap on how far underwater you can be, and lots of borrowers, especially in some of the most challenged markets, your Las Vegas is at 60% underwater from the peak. These borrowers have had really no opportunity. So this new HARP 2.0 does not have a cap. You can be as deeply underwater as you have to be. And the new 2.0 also has some streamlined documentation requirements so that you can just prove that you have a job. You don't have to prove how much income you have, just that you have a job. So for someone who used to be a 2-income household and is now a 1-income household who can't even technically qualify for the loan they have, here's a chance coming along for them to refinance.
And this is really the best chance because all the different permutations previously have pretty much been failures, right?
Well, let's just say they suffered from, unrealized expectations.
Okay.
Lots and lots of borrowers thought these might work for them. The fact of the matter is all these programs are kind of untested into the market. Lenders have been balky about it. No one wants to lose a lot of money on these. There's been issues with, making sure that insurances could be put in place and whatnot. So this is a little bit better. It's moved a little bit further along. So some more borrowers should be able to take advantage. But no, there's no one-size-fits-all on this, unfortunately.
Okay. Anil lives in the California Bay Area, and he is an aspiring first-time home buyer. Bad place to be a first-time home buyer, let's be honest. My wife and I are both employed with decent salaries. We're in our mid-30s. We have 2 kids. I don't want too much money stuck in my home as a down payment. I would prefer to have that money liquid and be able to invest it in a fully diversified portfolio. I'm not sure if such a thought is a good thing or not, and I want to live in the home that I purchased for a long, long time. So he gave me a bunch of different options in all of this, but he's got the options go something like this. 20% down for a fixed rate mortgage is 5% down for an FHA loan, 5% down for a jumbo conforming, 625, 500, and one has PMI, one doesn't, and then renting at $2,500 a month. So, what do you think, Gumby?
Well, I think the home purchase option is obviously really the best idea. I mean, he's in a market that's very well supported. Prices probably aren't going down anytime soon. I mean, at least they've been very solid relative to other markets in the country. The expensive renting, I mean, could he hang around and hope for a better opportunity to buy? it's going to be unlikely that's going to happen. I mean, rates are going to be higher in coming years. It's unlikely
And
they're
rents
ever
are
going to
up,
be lower.
by the way, 5% in the Bay Area over last year. 5% increase in rents.
Yeah, so you're looking at not a losing proposition, but an opportunity to buy is here today. Yes, there's some asset allocation he's going to have to do in terms of what makes him most comfortable. It's a matter of the intersection of your down payment, how much you want in reserves, closing cost, what your mortgage insurance is going to cost you. You know, he could always get into a program now, get into something that doesn't eat up his capital, like the FHA program, small down payment. Unfortunately, the mortgage insurance for that is going up. It was announced the other day.
What is it, 10% now?
No, it's going to go up by 10%. The premiums, annual premiums are going up by about 10%.
Yeah.
But your upfront cost is going up by 75 basis points. So
Ooh.
your upfront's going to be a little more expensive, going from 1% upfront to 1 3/4. Plus your annual premiums are going up. So your opportunities, the window's not closing quickly, but things are getting a little bit more expensive, and there's no reason to believe that they're going to get cheaper in the future for him.
Jack, am I the biggest wimp in the world? I want him to put 20 down.
Yeah, I would say the same thing. I mean, you know, I'm always the one who says, really, you know, people shouldn't just jump into a house because it's the American dream. It might not be right for them. This guy's got a dual income family, 2 kids, wants to stay there. That's the person who should be buying a house. And I think given recent history, yeah, 20% down. You know, we've people talk a lot about what's the best asset allocation. Is real estate going to do better, stocks, whatever. In this particular case, they have probably a pretty high income, so that mortgage deduction is more valuable for him. It's forced savings. They have to put that money in that expensive house every month. So I think the arbitrage he could get by putting less into the house and putting more into the market or whatever isn't as good a deal for him. So yeah, I like 20% down and just say, hey, that's the price of being a 2-income family with 2 kids.
Right, and I would also say that if you don't have, if 20% down depletes you of your emergency reserve fund, then don't do it. So you've got to save more money. Yeah. If you need your 20% plus your emergency reserve fund, so you have that set up in advance. Because I get very nervous that people buy houses and they're used to renting, and they're like, yes, it's just principal, interest, homeowners, and property taxes.
Roof.
You talk to roof, dryer, plumbing, whatever it is, it's more than you think.
Yeah. Well, I would say I wouldn't advocate him buying more house. Rather than saying,
true,
okay, I could put 20% down and get X house, $600,000 home. I wouldn't say put 3.5% down and buy a $650,000 home.
Right.
Retain your cash position. I mean, if that's what makes him comfortable and he's leery about putting it into his home, retain it. You can hold it in a cash position, feel comfortable about having your little egg to work from if you need it, flexibility and whatnot, your cash cushion. But the word is not leverage yourself even further. You're already going to be leveraged, but you could still preserve your cash and do that.
Right. Sure. Okay, so we got some action in the chat room. And first of all, here's from Jason, who wants to know, oh my gosh, what new obstacles do younger Americans face in pursuing home ownership? Does the American dream still exist?
Wow, I'm going to take off the coat for this one.
All right, young folks, what's going to be the hurdles?
Well, you're coming in at what by most means would be a traditional time for getting a loan and buying a home.
Right.
Remembering we just came out of the most, some would call it robust bubble in history for real estate. So now the pendulum has swung back the other way. We're back to underwriting standards that existed back in the 80s and into the 90s at times. We're at interest rates which are at fantastic levels. But unlike 5 or 6 years ago, you actually have to prove you're a viable borrower. You have to stand up, show your documentation, prove your creditworthiness. You're going to have to save some money. That's always a challenge for folks, to save enough money for a down payment. You're going to be required to have one. You have to be more of an adult than you had to be to buy a home just a couple of years ago. And so the challenge is to start to build your financial life. Get your credit organized. Go out, establish credit, go out, start to make inroads into that. Be wise with your money. Save some money. You don't have to buy the latest, hottest toys and phones and cars, and put a few dollars away. Start to build yourself into a position where you're comfortable, because it's going to be a big step no matter what you do. And then be prepared for running the gauntlet a little bit.
Yeah.
You're going to have to prove you are who you say you are.
Right. This is what your grandparents had to do to qualify, not your parents.
But your grandparents might have, in fact, your grandmother probably didn't work. Your grandfather worked, and he may have been at the same company for 30 years.
And had a nice pension.
A nice pension. So these are things that you probably don't have. You'll probably change jobs 7 times in 30 years. And you might have to scramble a little more. So that makes it harder. but it's just the new reality.
It's a consideration.
Jim just notes, he's in the chat room. If you want to join the chat, go to MoneyWatch.com and you can log in. He says that although Freddie and Fannie are launching the new HARP 2.0 program, it appears that not all lenders are going along with the limitless loan-to-value.
Well, that's been pretty much true all along. I mean, lenders, banks, servicers have been, let's say, beaten down by losses, beaten down by regulators. Everybody's really wary about writing new loans that would continue to be risky because they may be asked to buy them back again. So the most riskiest loans, if such a thing could be said, have been harder and harder to place. For the most part, the original HARP program was supposed to go up to 125 LTV. Most lenders didn't write loans past the original HARP, which was 105 LTV.
Right.
Because those more risky loans, more likely to fail, more likely to be have a walk away, lenders are on the hook. Now, the newest of the new HARP programs is intended to take lenders off the hook for some of that, to get more people through the
Right, that's the carrot.
That's the carrot, is we're not going to come back and ask you to buy back a loan which was good in the first place.
Right.
So, yes, lenders are still wary about that. Those rules are changing a little bit, and lenders will probably start to be more friendly. The open access component of the new HARP as well is if your servicer doesn't participate, you're free to go talk to someone else who does participate and get yourself a loan written.
Mark wants to know, why is private mortgage insurance not covering the majority of loss in foreclosure-related situations?
Private mortgage insurance only covers a portion of the loss because the way that policies are written is only intended to cover a portion of the loss. Fannie and Freddie may require a policy which covers up to 35% of the loss. Well, home prices have collapsed pretty well, as you know, and a home, by the time it's done going through the foreclosure process with all the legal costs, all the reacquisition costs, all of the management, could easily eat not only the 35%, but a whole lot more, too.
Wow.
So the mortgage insurance companies didn't get a bailout, have suffered mightily. In fact, several of them have gone out of business or are in a process of runoff. And they have suffered as well. They're covering everything they can, covering everything they're required to, but it's just not enough in a lot of cases.
Here's another question we got from email. Sentil says, my house is underwater and I have an equity loan on my home paying a high interest of close to 7%. I've been paying my mortgage without fail and on time for the last 7 years. I've approached the banks for an equity loan rate modification. There are no signs of any positive response or relief that I could get. Any options on a home equity, either a line of credit or a loan for a refi?
There is a second mortgage modification program that is actually in place. Most lenders didn't pick up on it. The fact of the matter is, in a second lien position, the lender's really going to be exposed to what could be total loss. They would rather you simply pay it at the terms you had. They really can't easily write you a new loan because technically you're underwater. They're writing an unsecured loan, and there are tax implications of doing that. So it continues to be a thorny circumstance. And second mortgages are the reason why a lot of HAMP loans really didn't work out too well.
Because the ones who had the first would do it, but they couldn't get the seconds to agree.
Correct.
Got it. Okay, Ralia just sent us an email. I have a 20-year mortgage ending in 2024. The original loan was $201,500 at a rate of 5.63%. Because in 2004, that was a good rate. A few years ago, I began sending in an extra $350 per month towards principal. And at this rate of repayment, the loan will be done by 2019. So shaving off 5 years, getting down to a 15-year.
Great.
The current lender sent me a letter in the mail to refinance my remaining balance of $124,000 for a rate of 3.88%. Is it worth it to start up a loan again for 15 or 20 years if I could really be done in 7?
That's always a difficult choice. The question is, do you need cash flow? Are you interested in, kind of changing out the way your debt and assets are structured? You might consider re-lengthening the term of the loan. But it sounds like this reader sending in this question is in a very good circumstance. Now, there's nothing that says she couldn't go look at a local institution to see if they might write her a 10-year mortgage.
Right.
So you're not going to extend it back a full 15 or 20 with all of that compounded interest again, but something a little bit shorter than that. Get the benefit of the lower interest rate and continue to prepay as you have. You could even shorten it up from the remaining 7 years to maybe remaining 6.5 or 5 or 4 years.
And Jack, I see this a lot from people who have kids who are going to college, and they thought, well, my 529 plan, the funds are down in value. If I refi, then I can help my cash flow. I can maybe take even a little bit of money out, and pay for school as I go along. What do you think about that?
I think if the deal is so good that you can pull enough cash to be significant out, then that's a very good idea. I think it does depend a little bit on their age. We always say it's important to save for retirement first, college second. So if they're approaching a situation where they're suddenly going to be retiring, they're going to have many years left in their mortgage without the cash flow to support it, that's not good. We hate to say it, but let the kid get scholarships. But if the cash flow works, absolutely go for it. One thing on this woman, I've forgotten her name.
Okay, Ralia, R-A-L-I-A.
If she goes to online calculator, she probably can just run the numbers and find out which bottom line is better for her, the total interest paid, and that'll give her a good sense. And plan fees. She's got to really pin the bank down. Okay, thanks for this great offer. Now give me a solid number on what you're going to charge me in fees.
Yeah, absolutely.
And are you a fan of rolling the fees into the loan?
It depends. Usually better to pay them out of pocket, but that says you have to have potentially thousands of dollars in cash handy. That not only is it handy, but you wish to commit to the process. And a lot of people don't want to necessarily, eat up some of their cash position, especially today when things are uncertain. So we actually have a great calculator at hsh.com that allows you to plug in your information once and then compare paying fees out of pocket, paying fees, rolling them into the loan amount, paying fees by rolling them into a slightly higher than market interest rate, and then looking at how those work out over periods of time. So a good opportunity to sit and go through the numbers, see if you, A, want to commit the money, and then B, what's your best application for doing so.
Raleigh just sent in, and she says she can't borrow any more money, just refinancing the balance. So go to hsh.com and check out the calculator.
Yep.
And
Refinance calculator.
Refinance calculator. Actually, I've linked to this many times from my radio show.
Great.
I just want you to know. All right. Here's a softball question, which can go any way you want it to go. Ainsworth wants to know, Jack, is it smart to pay off your loan early?
We've talked about that a lot. So purely by the numbers, I get to drag out my favorite academic study of all time. Purely by the numbers, you are probably better off putting money in your 401k than paying off your mortgage early. And the reason is that with your 401k, it's pre-tax dollars. So for every buck that goes in there, you're saving a buck, you're maybe getting a 50% match, and it's going to compound tax-free over the years. With your mortgage, you have to pay taxes first. So your company pays you $1, only 75 cents of that, let's say, actually goes to pay off your mortgage. That said, finances and the numbers are not the only factor here. The sleep at night factor is very important to some people, knowing that you own that house free and clear. And if it's really going to improve the quality of your life, knowing that, then I say go ahead and pay it off.
And I'd say, where's the money coming from? Did you win the lottery? Great. Pay off that mortgage, you're done. But paying it off and free and clear, for most people, it's going to be difficult. I mean, you're going to have to empty out most of your assets, or
That's
a big
the part
chunk
that
of your
makes me
assets,
nuts.
or
Yeah.
and for there may be an estate where a family member has passed away and left you some money, and the question is, how do I best commit these funds to really improve my life? And for most people, it's not paying off your mortgage, but rather setting yourself up so that your future is taken care of.
And having cash flow in place for an emergency or whatever.